Ever feel like your grocery bill is creeping up, and at the same time, your credit card balance feels heavier than ever? It's not just you. This is the 1-2 punch of inflation and interest rates hitting your wallet. And today, we're going to break down exactly what that means for you in simple terms. So, let's start with the first culprit, inflation. What is it really? Simply put, inflation is when the prices of goods and services go up over time. It means your money buys less today than it did yesterday. Think about that favorite lunch special you used to get for $5. A few years later, that same meal might cost you $7 or even $8. That's inflation in action. The item hasn't changed, but its price has. Now, you might be thinking, a few cents here, a dollar there, what's the big deal? But here's why inflation is such a silent wallet shrinker. It erodes the purchasing power of your paycheck. Let's say you get a 2% raise at work, but inflation is running at 3%. In real terms, you've actually taken a 1% pay cut because your money can't buy as much as it used to. Even a seemingly small 3% inflation rate each year can reduce the value of your money by over 30% in just a decade. It's like a slow leak in your financial tire, gradually letting the air out of your savings and your income. All right, so if inflation is the problem, what's the solution? This brings us to our second key player, interest rates. An interest rate is essentially the price of borrowing money. When you take out a loan, the interest rate is the extra you pay back. When you save money in a bank account, it's the reward the bank pays you for letting them use your cash. And who decides these rates? Mostly, it's the central bank, like the Federal Reserve in the US. They are the financial world's DJs, trying to find the right beat for the economy. Here is a great way to think about the relationship between inflation and interest rates. Imagine a thermostat for the economy. When the economy gets too hot, meaning prices are rising too fast, which is inflation, the central bank turns up the air conditioning by raising interest rates. This makes borrowing money more expensive for everyone, from individuals buying cars to big companies expanding their operations. When borrowing costs more, people and businesses spend less. Less spending cools down the demand for goods and services, which in turn helps to bring inflation back under control. On the flip side, if the economy is too cold and heading toward a recession, the central bank can lower interest rates to encourage borrowing and spending, effectively warming things up again. So, inflation and interest rates are in this constant dance, one rising to cool the other down. Let's make this even more concrete with a real-life example that hits home for many: housing. This brings us to the impact on debt, especially high-interest debt like credit cards. When the central bank raises interest rates, the rates on your credit cards often go up too, because they are usually variable. Let's say you're carrying a $1,000 balance on your card. At a 15% annual percentage rate, or APR, that debt would cost you about $150 in interest over a year if you just paid the minimum. But if that rate jumps to 22% because of broader interest rate hikes, that same $1,000 balance now costs you $220 in interest per year. Your debt is suddenly growing faster, making it harder and more expensive to pay off. It's like trying to run up a down escalator that's just sped up. But it's not all bad news. What about your savings? This is where the story gets a little more interesting. In a period of high inflation and low interest rates on savings accounts, your money is actually losing value. If your savings account pays you 1% interest but inflation is at 4%, your money's real purchasing power is shrinking by 3% every year. You're saving, but you're falling behind. However, when interest rates rise to combat that inflation, savings accounts finally start to pay more. Suddenly, you might see high-yield savings accounts offering 4% or even 5% interest. If inflation has cooled down to, say, 3%, your savings are now actually growing in real terms. You're earning 5% and only losing 3% to inflation, so your money's purchasing power is increasing by 2%. For the first time in a while, your savings are actually working for you and building wealth. So, let's tie this all together. How do these two giant economic forces, inflation and interest rates, show up in your everyday life? It really boils down to three main areas. First, your cost of living goes up. That's inflation making your groceries, gas, and rent more expensive. Second, your debt becomes heavier. That's higher interest rates making your mortgage, car loan, and credit card balances more costly. And third, your financial strategy has to adapt. When rates are high, it's a great time to focus on paying down high-interest debt and boosting your savings. When rates are low, it might be a better time to borrow for a big purchase or invest for long-term growth. Understanding this dynamic is crucial for making smart financial decisions. To recap, inflation is the silent force that makes your money buy less over time. Interest rates are the tool used by central banks to manage the economy, influencing the cost of borrowing and the reward for saving. When inflation is high, interest rates tend to rise to cool things down. Your wallet feels this dual pressure through higher prices on everyday goods and more expensive debt payments. But it also creates opportunities, like earning more on your savings. It might seem complicated, but by understanding these basic principles, you're already way ahead of the curve. You're no longer just a passenger in the economy. You're becoming an informed driver who can navigate the twists and turns. Thanks for sticking with me through this deep dive into economics. I hope this cleared things up and made these big concepts feel a lot more manageable. If you found this helpful and want more simple explanations of the financial world, make sure to hit that like button and subscribe to the channel. We've got a lot more to cover to help you master your money. See you in the next video.